Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful Pacific Northwest, and we are live on Facebook. I hope you guys are doing great. Hope everybody's staying healthy, staying safe, staying sane in a very strange and insane world. And I hope you guys are ready for a wonderful Father's Day. Before we go too far into our update for this week, let's take a moment to celebrate dads all around the country, all around the world. Dads are awesome. And I hope you guys have a wonderful Father's Day planned for your time with your dads, wherever they may be. I am working out of the beautiful studios of New American Funding, but at the same time, I'm going solo. So I don't know exactly where my camera is. I don't know, my colleague Dana is not here today, so I don't know if I look good. If I don't look good, I'm going to assume that I look great. But at the same time, I know that perception is not necessarily reality. So I apologize in advance for any weirdness, for any snafus, for any additional distractions. But I wanted to jump on and talk with you guys, as I mentioned in my teaser for today's conversation. The Federal Reserve Board, the FOMC, Federal Open Market Committee, met yesterday. They actually meet for 2 days every 6 weeks. So they met on Tuesday, and then on Wednesday they also met. But on Wednesday was what they released to the public, the big outcome of their meeting. And they meet every 6 weeks. And so this last meeting, they decided to put a pause on rate hikes, which is very, very interesting. The Fed decided, hey, you know what? We're going to take a breather. We're not going to stop. We're not going to continue. Right now, we're just going to hit pause and see what happens over the next 6 weeks with the economy, with the world in general. And then we'll make a decision at the July meeting. So they'll be meeting again at the very end of July. They'll decide how they want to continue, what they want to do, where they want to go, and we'll see. I mean, we'll just absolutely have to see. Now, one would think that the markets would have responded very favorably to this, and to a certain degree they have. The markets, it's interesting, I forget who said it. I want to say it was like Charles Schwab, like the original person, but it might have been some other trader from many, many years ago who said the market can remain irrational longer than you can remain solvent. And what that basically means, and he was talking about the stock market in specific, but what that basically means is that I was expecting, and I still am expecting, a major correction in the stock market, the S&P 500, the Dow Jones Industrial Average, the general stock market, the NASDAQ. I've been expecting this for more than a year now, because what history has shown us is that the markets, when the Federal Reserve Board starts to really hike interest rates to fight inflation, the stock market has responded negatively and stocks go down. That has been historical. And when I say historical, I mean years and years ago. This has not been the case for many, many years that we've had this kind of inflation, let alone this kind of Fed response to it. And so reading the history, there's an old saying, history doesn't repeat itself necessarily, but it certainly rhymes. And what that means is that you can expect similar patterns, you can expect similar outcomes, even though it won't be identical. And so when I saw the inflation that we had at this time last year and in the months leading up to this time, like starting in March of 2022, I thought, wow, the Federal Reserve Board, in their efforts to fight inflation, is going to really put a hammer on the stock market, and we're going to see the stock market values come down. Well, we are testing new highs at the S&P 500. We've crossed over a value of 4,400 in the S&P 500, and it seems to be continuing to go up. And that's great. I have no qualms about that. I do have investments in the stock market, and when it does well, I do well. So I certainly don't want to see negative things happen in the stock market. I'm surprised. I'm scratching my head. I am wondering, like, how is this different today than it was in 2007 and 8, or that it was in 2001 when the Fed had to deal with weird inflation and a weird economy back then, and the stock market really responded in a negative way. And frankly, I don't know. And this is why I let people who are more educated and more on top of the stock market kind of take care of a lot of our finances and a lot of our investments, so I don't have to worry about it, so I can spend my time doing stuff like this and doing mortgage loans for our clients and our colleagues. So I don't really know what's going on, other than to say I'm glad that we're participating, because it's a very interesting rally, and it's a really strong rally, and good. I mean, you know, a lot of our clients have stock portfolios. A lot of our clients are paid with stocks from the companies they work for, whether that's Amazon, Microsoft, Google, Facebook, you name it. They get a lot of stock as part of their compensation. And so when the market goes up, everyone has more money in their portfolio, everyone feels better about things, and I'm certainly happy to see that. Although it is a head scratcher, and again, that statement is the market can remain irrational longer than you can stay solvent. So basically what that guy was saying is, don't argue with the market, right? The market will do whatever it does, and your staying power is probably not as great as the market's ability to continue moving in a particular direction. So the stock market and things notwithstanding, the question is, what's happening with the Fed? So the Fed basically left interest where it is. And where is that? Let me share my screen with you here. Hold on one second. It's been a little while since I've done this. Let me pull this up and find, here's what I want to show you guys. So, okay, hopefully you guys can see what I'm looking at here. This is the Fed decision. The Fed funds rate is currently between 5% and 5.25%. What does that mean exactly? That means that if you are a bank and you need to borrow money from the Fed, and the Fed is basically the lender of last resort at this point, then they're going to charge you as a member bank between 5 and 5.25% to loan you money for a very short-term period of time. How short is short-term? A couple of months, a couple of weeks, somewhere in between there. Not a long-term loan, but this is what the Fed is charging member banks in order to be the lender of last resort on their behalf. And keep in mind that on March, or in March of 2022, let's say in February of 2022, before the Fed started to really take inflation seriously, this number was basically 0 to 0.25%. So basically, there was free money from the Fed if you were a bank and you needed the Fed as a lender of last resort. So in the last, how many months is this? 15 months, 14 months, 16 months since last March, we have seen the Fed increase their interest rates by 5%. That's a lot. That's a whole lot. Now, they hit pause yesterday. They decided not to increase it by another 0.25%, but 9 members of the Fed want 2 more rate hikes sometime this year. So a lot of people at the Fed have said, hey, we're not done with this yet. We had some interesting numbers come in from the inflationary metrics of the consumer price index. CPI, consumer price index, is a measure of inflation. It's not the Fed's favorite measure of inflation. That is PCE. Also, it's short for personal consumption expenditures. But whatever the case may be, on Tuesday, the CPI number, the consumer price index number, came in, and the number was actually pretty good, meaning that the rate of inflation seemed to be coming down from one month to the next and from one year to the next. And that should have been celebrated by the markets, should have been celebrated by the Fed. But the Fed, like I said, 9 members want to at least 2 more rate hikes this year. That's a lot. So that would take the Fed funds rate to between 5.5% and 5.75%. Keep in mind now that your credit cards, if you carry a balance, they are going to increase their rates that they charge you by 0.5% if the Fed increases their rates by 0.5%. Same thing with your home equity line of credit. Any loan that is not a fixed rate loan will see interest rates go up if the Fed continues to raise rates. And 9 members want to raise at least 2 more times, so at least another 0.5%. Now, why do they want to do that? Because the core personal consumption expenditures, the core PCE, is currently at 4.7%, and they want to take that down to 2%. Now, that is a huge move. They want to cut that by more than 100%. That is a lot. That is a ton of work that still needs to happen. And we're expecting the core PCE in the next few months to be between 3.9 and 3.6%. So coming down significantly. But when the Fed says we want it at 2% and we're going to continue to increase interest rates until it gets to 2%, that is a Herculean task. Inflation is a lot tougher to deal with than you think it is. And I was listening to someone talk about it today. He made the comparison and the analogy that inflation is kind of like cancer. You want to catch it early. The earlier you catch it, the easier it is to deal with it. If you catch it late, it becomes very, very difficult, very, very persistent, and the cure could be as bad as the disease itself. And the same thing is likely or possible to discuss with the rate of inflation. And so we've got a real problem on our hands. Now, the gross domestic product, they're saying is roughly 1%, up from 0.4%. So the economy is growing still, even in the face of inflation. So the year-end projections, here's what we're talking about. They're expecting the gross domestic product to continue to grow, even though we've got inflation and even though they're raising rates significantly, and they're expecting the unemployment rate to be somewhere between 4.1 to 4.5%. Well, currently the unemployment rate is 3.7%. So they're expecting unemployment to go up, and they want to see unemployment go up. This is part of what Jerome Powell, the chairman of the Federal Reserve, and all of his colleagues, this is kind of what they're trying to establish here, is the higher the rate of unemployment, the less money is paid to employees. When you've got a lot of unemployment and people need a job, they will take any job, not the one that's paying them the highest, not the one that's giving them a signing bonus, not the one that's giving them greater income than they're currently receiving. And so the Fed, in their infinite wisdom, wants to see higher and higher unemployment, because that, more than anything else, is what is going to bring these numbers down. Currently, we're at 4.7% core PCE. They expect it to be somewhere between 3.9 and 3.6% by the end of this year, but they wanted it 2%. And they're going to continue to tighten until unemployment goes high enough to bring this core PCE number considerably lower. And that is really, really scary. And that is really, really dangerous. Now, why is that so scary and why is that so dangerous? Okay, let's look at where we are. This is core PCE over the past 12 months. So when we talk about replacements, remember, this is a little bit tricky, but think about this like the cars on a train, right? So every time the train moves forward that direction, this number, one of these numbers falls off. So the next month, this number is going to fall off. And the month after that, this number is going to fall off. And the month after that, this number is going to fall off. But in order to get core PCE down to the Fed's target rate of 2%, these numbers, these replacement numbers, have got to be somewhere at 0.166% every month for the remainder of the year, just to reach the Fed's target. That is really hard when you consider, look at these numbers. I mean, we've got only 1 month, and that's July of 2022, when the core PCE number for the month was at that necessary level of 0.166% in order to achieve that math. Every other month in the past, in the last year, has been significantly higher, in many cases twice as high, in some cases 3 times as high, but only once in July of 2022 did we have a core PCE print for the month that was low enough to achieve what the Fed wants to see for the next 6 months consecutively as an average. So what they're saying, yeah, we want to see core PCE at 2%. In order to get there, let me straighten myself up here. In order to get there, we're going to have to see something that we've not seen before. How in the world are we going to achieve that? How in the world are they going to achieve that? It's very hard to actually put a finger on it and see what is going to happen with their actions and what they actually have to do in order to achieve their stated goals. This is how bad the Fed messed up in the months and years leading up until this point, leading up until March of 2022, when they started raising the interest rates. This is how deep a hole they dug us into, that now, in order to get out of that hole, we have to see in our economy something that we have not seen yet. And we need to see it consistently for the rest of this year in order to try and achieve what it is that the Fed has stated that they want to see. That is really scary. And I don't know how they're going to do that. And I don't know what the fallout from that's going to be. But I will tell you that for every action, there's a reaction. And the reaction that the Fed is really aiming for is job loss. The Fed has said it. I've seen interviews or a testimony, I should say, where the federal chairman or the chairman of the Federal Reserve Board, Jerome Powell, is being grilled by members of Congress, being grilled by members of the Senate. And basically, they're speaking to him and saying, so you want to see unemployment really rise? Well, no, I don't want to see that. But I mean, the long and the short of it is that that's actually what they do want. And that's what they've said. Now, that's politically detestable. It's hard to defend something like that when you're the chairman of the Federal Reserve Board and you don't want to come off as a monster. And so they kind of massage the language and they try to kind of sweet talk and they try to maneuver and, well, that's not exactly the case and so on and so forth. But that is the case. That's exactly the case. And here we're looking at a chart for initial jobless claims. Okay, this is people filing for unemployment benefit for the first time. And if you look at the nature of this graph, yes, in what is that? In October of 2022, we hit a low point. But the nature of this graph is very positive. That doesn't mean that it's a good graph. That just means that the slope is going in a positive direction. Look at where we are now compared to where we were in October of 2022. The initial jobless claims have gone significantly higher. People are filing for unemployment benefits at a greater pace than they have in a long time. And they continue to file for unemployment benefits, first-time jobless claims, because what the Fed is doing is, for lack of a better word, working. Remember, the Fed wants to see people lose their jobs. They won't say that out loud unless they're really pushed into a corner, but that's really what they're trying to do. When people lose their jobs, they stop spending money. When they stop spending money, the price of things goes down. Their consumption of things goes down. When you don't have a lot of money in your pocket, you're living on savings, you stop taking vacations. You stop going out to eat. You stop buying more clothes. You don't buy a new car. You don't buy a used car. You don't buy a new TV. You basically don't do anything until you get a new job. And when you get a new job in an environment and in an economy where people are losing so much of their employment, where they're worried about losing their employment, and you're offered a job, you're not going to argue with that employer and say, you know what, I want more money than what you're offering. Or, yeah, I want to take your job, but I need a nice, big, fat bonus to join your company. When you're worried about losing your job, when you've lost your job, or when you're worried about not being able to find a job and someone offers you a job, you're not going to push back and say, I want more money. My uncle used to say something about the world in general. When you're starving for anything and someone offers you a cracker, you don't push back and say, no, I want it to be a Ritz cracker with butter. You'll take whatever crumb is available to you because you're starving. And this is what the Fed is trying to create within our job market, within our employment base, so that people kind of recalibrate their expectations for income, recalibrate their expectations for employment, and will take any job that's given to them. And as a result of that, wage pressure will come down. And when wage pressure comes down, when people are just not making as much money in general, they're not spending as much money, the cost of other things comes down, the consumption of other things comes down. And this is the Fed's method for dealing with inflation. And I can't say it's right. I can't say it's wrong. It's not my place. I think it stinks. In general, I think where we are economically is dreadful. I'm absolutely mortified that this is the only solution that they're willing to offer, because our elected officials on both sides of the political spectrum continue to spend money that we clearly don't have. And that's really the cause of inflation. We can talk about COVID, and we can talk about supply chains, and we can talk about stimulus checks and everything else, but inflation is really created by a government, any government, not just ours, but any government that borrows more money than we have. And that has been the case. And over the last several years, we have seen 6 trillion new dollars introduced into our economy. And that is definitely inflationary. So without going too deep into the cause of where we are, let's see where we are a little bit further. This is continuing jobless claims. Okay, so up here, these are people filing for jobless claims for the first time. After the first time, you're no longer an initial jobless claim filer, you are a continuing jobless claim filer. Now look again, look at this graph. Look at the direction that this graph is going in. More and more and more people are filing for continuing unemployment benefits. They are desperately looking for work. They need to get a job. And our unemployment rate has gone from 3.4% to 3.7%. Now, those numbers are cooked. I will tell you that when you dig deeper into the unemployment numbers, you will find that a lot of people may be employed, quote unquote, but they're working fewer and fewer hours. So how much money they're actually earning and how much money they're actually taking home is significantly less than what that low unemployment rate suggests. So yes, 3.4% unemployment rate, now rising to 3.7% unemployment rate. But when you look at the direction of this trend, it is frightening to think what is going to happen when you talk about the Fed continuing to raise interest rates. Again, 9 members want at least 2 more rate hikes this year, and their expectation of unemployment rate to go from 3.7% where it is now to somewhere between 4.1 and 4.5% by the end of this year. And still, that's probably not going to get the core PCE, the Fed's favorite measure of inflation, down to the 2% that they wanted to. It would be twice the Fed's target by the end of this year, if we're lucky. So think about what kind of economic damage and carnage the Fed is talking about doing until they get to their target. I'm not saying this because it brings me joy. I'm not saying this because I'm excited for it. If anything, I am frightened of it. The only silver lining is that when the Fed causes a recession, and it seems to be that they want to cause a recession because that is a surefire way of bringing the rate of inflation down. When the Fed does cause that recession, the long-term interest rates that we offer through mortgage lending are going to come way down. And that is a silver lining, and that's great. But if mortgage interest rates are way down, but we're at an unemployment rate of 5 or 6%, which is possible. I don't know. I'm just looking at these calculations here, looking at these numbers, and I'm trying to extrapolate. If we're at 3.9% PCE and we're at 4.1% unemployment, then what do we have to do in the unemployment rate to get this number cut in half? What does this number have to increase to? That scares me. That's a concern. I mean, there's an action and a reaction in our economy. Nothing happens in a vacuum. And this is what the Fed is telling us. This is from them. I didn't make this up. I am just reporting what happened as recently as yesterday. So we are looking at a very interesting economy and a very interesting situation while at the same time, let me show you something else here real quick. Hello, here I am again. Let me show you a live screen of the markets right now. Bear with me while I look for it. Hopefully I can find this and not cause massive feedback. Bear with me. That's not what I'm looking for. Hold on. I just want to find a chart of the S&P 500 here. Here we go. Bear with me, guys. Sorry. This is, it's live. What can I tell you? It's live. Let's see. Here we go. Share that. Okay, so the markets are closed right now, but here's the S&P 500 index up another 53 points at 44.25. Let me show you this chart here, because one would think that with the economy going the direction that it's going, with the Fed causing or desiring to cause the unemployment that they're saying, with, you know, the rate of inflation still being confoundingly difficult to deal with. This is the broad market, the S&P 500. This is representative of 500 stocks in the United States, 500 publicly traded companies. Look at this chart. This is from March of this year. Look at the positive slope on this chart. The stock market is having a monster rally. And this is one of those kind of head-scratching things. As I said before, the market can stay irrational much longer than you can stay insolvent. One more time, let me say it again the right way. The market can stay irrational longer than you can stay solvent. So if you were wagering, if you were betting that this market was going to go down and going to go negative because the rate of inflation, the Fed's efforts to combat inflation, unemployment, so on and so forth. If you were betting that this market was going to go down rather than up, you are losing that bet, and it's costing you a lot of money. In fact, this is, I don't know if it's a 52-week high, but it's certainly 44.25 is definitely on the high side of where the stock market has been. Let me see if I can expand. Yes, 2-year history. We're still off of the lows of where we were 2 years ago, but we have made a huge comeback in the stock market. And that is really just a head scratcher. I'm not saying it's good. I'm not saying it's bad. I'm just giving y'all a lot of data and a lot of information, because I'm also trying to make sense of where we are and where we're going. The Fed has told us in no uncertain terms that they want a 2% core PCE number. We are at much higher than that right now. How we're going to get there, I don't know. What kind of damage they're going to cause along the way to get us there, I do not know. But this is kind of where we are right now. So I'm just as confused as the rest of us. I am sharing this information with you because everybody needs to kind of get a sense of where things are going. The home buyers are still out there. The home shoppers are still out there. Mortgage interest rates continue to be much higher than we'd like them to be. I think that as the inflation rate comes down, mortgage interest rates will come down as well. That is kind of a corollary. It goes hand in hand together. What needs to happen to get that rate of inflation down? Because the Fed's been hiking interest rates significantly over the last 14 months, 15 months, and there just doesn't seem to be any real impact on the rate of inflation fast enough to match the Fed's efforts. So we're still kind of working through this. I do think that we're going to see additional rate hikes in the coming months, because the Fed has told us in no uncertain terms they want a 2% core PCE. The PCE, the personal consumption expenditure number for the month of May, is going to come out at the end of this month, the end of June. We'll see where we are, and we'll see what the Fed continues to do. In the meantime, we have an opportunity, and I'm going to finish with this highlight, with this high note. Yep, we're just about 2:30. If you want to buy a house, there's a lot of people right now that are not buying a house because they just don't know what the employment situation is going to look like, what the market situation is going to look like, what the interest rate situation is going to look like. So competition is still stiff, but it's not nearly as fierce as it will be when we crest, when these interest rates come down, and when there's a lot more interested parties in buying a home because they've got lower interest rates, and they feel like they can finally go out and get what they want. So now is the time. If you really want to buy a house, buy that house now. We'll refinance in 6 months to a year, and things will kind of even out. But right now, that's the only silver lining I've got for you guys. That and the S&P 500 seems to be just doesn't care what the Fed's doing, doesn't care what the economy's doing, seems to be in rally mode. And that's great. If you went long and you're investing in stocks that are in the S&P 500, then hopefully your portfolio at least is a ray of sunshine in an otherwise weird and strange world. But doesn't matter. Things will improve. They always do. We'll continue talking about it. I'll continue to bring you more and more information. Until then, have a fantastic Father's Day weekend. Enjoy time with your family. Those are the most important moments. Believe me when I tell you. Please come back next week. I'll have more information for you. Until then, stay safe, stay healthy, stay sane. Thank you so much for joining me, and I will see you next week. Y'all take care.